Hi, everyone. Good afternoon and welcome to the annual Financial Services Conference, the afternoon session entitled Embracing Change in a Time of Uncertainty. Now, the coronavirus pandemic, as we all know, has triggered the severe economic downturn. At the same time, financial players and policymakers have created an alliance to try and reboot the economy. So with the Sustainable Action Plan and the launch of the European Commission Platform for International Sustainable Finance and the consultation on this renewed sustainable finance strategy, Europe has shown its commitment to sustainability and all green things. Now, it's my great pleasure to introduce now Mary Schapiro before we go to a panel where you'll also have a chance to submit questions to our great panel. Mary Schapiro really needs no introduction, but she's vice chair of Bloomberg LP, head of the Task Force on Climate-Related Financial Disclosures Secretariat, and vice chair of the Climate Finance Leadership Initiative. Mary, over to you.
Thank you, everyone. It's really a pleasure to be here, most especially with this great panel and my brilliant colleague, Bloomberg's editor-at-large, Francine Lacqua. So as Francine said, my assigned task is to help set the stage for our panel discussion, Financing the Green Recovery, with a bit of an overview of what's happening globally. Of course, for the past 6 months, the global focus has rightly been on the human and economic devastation of the COVID-19 pandemic. But amid this current health crisis, we should not forget the ongoing risk of the climate crisis, nor ignore the numerous parallels between this pandemic and climate risk, which may help us and help guide us in building back better. Coronavirus delivered both a severe shock and a wake-up call, regardless of where you live. Globally, we are seeing governments, corporations, and civil society grapple with unprecedented disruption that emerged virtually without notice and has overwhelmed us. We are in the midst of a health and economic crisis that is changing our future forever. Yet we all know that this is a precursor to what could happen to a world in which climate change is permitted to truly wreak the havoc it threatens. Coronavirus has defined our present. How we navigate the global recovery will define our future. As we look around the world, there are many important initiatives driving climate change to the top of the agenda. Europe is leading the way on the green recovery, with many efforts focused on the financial sector, because without your participation, we simply cannot meet our climate goals. The European Commission has made it clear that climate is at the heart of its agenda and budget, and has made the green transition a key pillar of Europe's post-COVID economic recovery, mobilizing over €1 trillion of sustainable investments over the next 10 years to channel both public and private investments to transition into a climate-neutral economy by 2050. Since the launch of the Sustainable Finance Action Plan in 2018, the EU has brought forward flagship legislation, such as the taxonomy, to bring clarity on what can be defined as sustainable activities, and adopted key legislation to drive sustainable investing by creating new categories of low carbon and positive carbon benchmarks, and by setting sustainability disclosure requirements. The EU's leadership on sustainable finance is also evident in the drive to hardwire ESG requirements across the full spectrum of EU finance legislation, and it's great that this work will continue with a renewed sustainable finance strategy expected by the end of 2020. The European Central Bank has also become a key driver for climate finance by identifying and assessing the risks posed to the financial system by climate change and working to ensure that supervisors and regulators in Europe and beyond are acting consistently to drive the economy towards the green transition. I very much welcome that the ECB recognizes the work of international frameworks and standard setters, such as the TCFD, to shape climate risk considerations and incorporate disclosure in its response to the non-financial reporting directive consultation. As evidenced by the rapid growth of the central bank's network for greening the financial system, central bank supervisors are playing an ever more critical role in the fight against climate change, committed to demonstrating that tackling climate-related risks is a core part of their mandate of ensuring financial stability. And last year at the IMF meeting in Washington, Executive Vice President Dombrovskis launched the International Platform for Sustainable Finance to engage global capital markets in the opportunities for investment in the transition to a low-carbon world. While policymakers, especially here in Europe, have been committed and purposeful in confronting climate risk at nearly every opportunity, they are not alone. Particularly in the realm of corporate disclosure of climate-related risk, we have seen momentum and progress around the world, primarily in the form of support and even mandates for disclosure aligned with the framework recommended by the Financial Stability Board's Task Force on Climate-Related Financial Disclosure. Created under the leadership of former FSB chair and governor of the Bank of England, Mark Carney, and Bloomberg founder, Mike Bloomberg, the TCFD is premised on the idea that we can harness global market forces in the fight against climate change by providing investors, insurers, and lenders with the information they need to direct their capital to the most sustainable assets and investments. In June of 2017, the task force published recommendations for companies to develop more effective climate-related financial disclosure through their existing disclosure processes. The framework rests on 4 pillars of disclosure: governance, risk management, strategy, and targets and metrics. And it asks companies to disclose how they think about, measure, manage, and mitigate climate risk. We're very pleased to see that in June 2019, the European Commission incorporated the TCFD recommendations into the NFRD. Located in 73 countries on 6 continents, the more than 1,300 TCFD supporters span the public and private sectors, including companies that have a market capitalization in excess of $12 trillion, and more than 600 financial firms supporting the TCFD disclosure framework are responsible for assets of nearly $150 trillion. TCFD disclosure is important not only to market participants, though, but also to policymakers and regulators in the context of understanding the impacts and risks that climate change presents for the financial system at large. A growing number of governments and financial regulators around the world have expressed support for the recommendations and are integrating them into their guidance and policy frameworks. In Japan, Prime Minister Abe has said that TCFD makes possible the virtuous circle of the environment and growth, and has launched with the Ministry of Economics, Trade and Industry a vibrant effort promoting the use of TCFD disclosure by Japanese companies. The Bank of England has given a clear commitment to TCFD and used it to carry its first climate-related financial disclosures as part of the annual reporting for the financial year 2019-2020, published just a few days ago. Among other UK regulators' efforts, the FCA is actively working to integrate the TCFD recommendations on a comply or explain basis, asking all commercial companies with a premium listing to either make climate-related disclosures consistent with TCFD or explain why not. In Canada last month, Prime Minister Trudeau announced plans to establish a large employer emergency financing facility to support businesses during the pandemic, with the condition that companies disclose information in line with TCFD recommendations. Further, as an increasing number of countries commit to being net zero by a date certain, as the EU has done, TCFD disclosure will be essential to monitor the progress of businesses and industries on their own path to net zero in support of their national goals. Net zero will require what Mark Carney has described as a whole economy transition. And by the way, one that presents extraordinary opportunity as well, as we rethink, transform, and refit building stock, transport systems, agriculture, and the energy sector. And finally, there's another investment opportunity that is highlighted by the parallels between climate and the pandemic. A recent study of more than 700 European-based sustainable funds found they outperformed peers over 1, 3, 5, and 10-year periods. The relationship between strong environmental, social, and governance performers and their financial strength is clear. Organizations and businesses which understand their present and potential exposures and risks from climate and other disruptions are more resilient and better prepared for the future. While the impact of the climate crisis poses a less visible risk than this pandemic, it is no less imminent, and the repercussions of inaction at this stage are just as profound and existential. A green recovery in which we build back better can help to ensure a more resilient and sustainable world. I look forward to hearing from my fellow panel members and to share our insights on how we can continue to promote this green recovery. Thank you, Francine.
Mary, thank you so much. Now joining Mary and myself here for the panel, Jane Ambachtsheer, Global Head of Sustainability at BNP Paribas Asset Management, Erick Decker, Chief Investment Officer of Emerging Markets and Head of RI Center of Expertise for AXA Group, Andrew McDowell, Vice President of the European Investment Bank. Now, I urge also everyone listening in, and thank you, Mary, for a great scene setter. Everyone who's listening in, please send questions. You can do so on the right hand so we can make it as interactive and we answer as many questions from you as possible. We also have a poll. So before we get to the panel, I want to ask you just to get a brief overview maybe of the mood of everyone listening in. What do you see as the biggest risk globally? You have COVID-19, second wave, the global pandemic, 2, climate change, 3, cyber attacks, and 4, war and conflict. So as you answer that, those are the four possibilities to answer. Let me start off with you, Jane. Have we seen actually a changed way asset managers look and address climate issues, given we're going through this huge economic crisis?
I think that we are. I think, of course, in the beginning, COVID was arguably, taking people's mind off of climate because of the impact and the urgency. But I think, as Mary has highlighted, it's really provided an opportunity to kind of double down, right, in terms of building back better, where we have this opportunity to channel reinvestment and investment into green activity. And I think it's been great to see so many different voices kind of coming to the table to articulate that we really need to focus on making the recovery a green one.
Andrew, do you agree with that? So again, if you just look at COVID-19, if you look at the trend, I guess, at which, sustainability was at the forefront of the agenda, this, renewable green access, is it a chance to reset and go even further to accelerate the transition, or does it pause the green transition?
Good afternoon, Francine. Good afternoon to your audience, and thank you for the invitation. I think it's certainly an opportunity to accelerate. What we see in Europe at the moment, I think, is quite exciting. As Jane has said, there's a growing political consensus in Europe to push the green transition at the heart of the recovery strategy from COVID-19. I think we'll have two things supporting that in the coming months. Firstly, we'll have more public money, and this is coming quite clearly out of the Commission's new budgetary proposals and its recovery plan. And as you know, for the first time, the Commission is proposing to issue common EU debt to help support the recovery. What's less debated, of course, or less noticed, is the fact that an awful lot of that money is going to go to financing the European Green Deal. The second thing that we'll have, obviously, arising out of the work of the task force and the adoption of a lot of the task force recommendations into the EU Sustainable Finance Regulation, is much greater clarity and much greater consistency on what is green investment and what is green finance. And I think this is indeed going to be a game changer in terms of the mobilization of the private sector to help support a green recovery. So I firmly believe, notwithstanding the human and economic devastation arising out of COVID-19, that in 5-10 years' time, we will look back at this moment and recognize it as a turning point in the fight against climate change.
Erick, do you agree with that?
Oh, for sure, having access, to more financing, and I think what is making the change is the leadership. It started a long time ago, and it's slowly making its way into our investment decision. So if we look at the asset owners, and Mary, in your introduction, you've mentioned the numbers and the AUM, or the asset under management. that are now concerned and having made a net zero commitment by 2050. When you look at those numbers today, by definition, we have changed. We are in a new world. And when we look at all of our, ourselves, asset managers, yes, we are now looking at the decisions we are making. And if those decisions are in line with our commitments, asset managers need to make sure that for their clients, having chosen a net zero 2050 commitment, are indeed choosing the right investments. And so it is making a difference as of today.
This is a perfect time, before I go to Mary, maybe to actually get the mood on my second poll, which is, how do you think the pandemic has changed companies' efforts to go green? So it's multiple choice again. You say green is no longer a priority. Green is on the back burner until mid-2021. And 3 companies are powering ahead with green initiatives. Mary, I mean, you've done so much work actually on transparency, right? And actually trying to find a common language for this and data board. I mean, until we have that and everyone adopts it, how difficult is it to go to the next step?
As a principle-based approach that would work for small companies and large companies, companies in any part of the world, even private companies in any sector or industry. And it's principles-based and it's somewhat flexible. The next step has got to be to bring some specifics to fill out the framework in a way that gives us truly comparable information. Because the value of a disclosure framework is to see what's happening in a company over time, as in the transition to a green or net zero economy, but also to be able to compare one company to another for the purposes of making capital allocation or investment decisions. And TCFD does that now, and it's a great start, but it needs to be filled out with more detail and more specific data in order to give asset managers and asset owners, investors and others, the most granular decision useful information for their purposes.
So I have the results from the first poll, which is, what do you see as the biggest risks to the risks globally? And we have 64% of you who think that it's climate change. So at least we have a captive audience right now to go more on what can be done on data. Jane, when, some of the work that you're doing in terms of finance, what do asset managers need concretely? What do they need in the next 6 to 8 months to make stronger informed decisions that are useful for everyone?
Well, where to start, right? We need different things from different stakeholders, I guess. So, I mean, of course, from companies, we need data and information, and we'd like to have a commitment and to see more roadmaps towards Paris alignment. In a policy context, I think companies and us, being down the chain as their investors, need clarity from policymakers. So I think it's very helpful, in a European context, even if some of these types of disclosures or requirements have a bit of a teething process for companies, at least they have a pathway that they may have confidence in. I think in other jurisdictions where it's less clear what the policy environment will be, it's harder for companies to make those longer term commitments. And I think that's where investors have an even stronger role to play, not only in influencing companies through our engagement and through our active investment decisions, but also by engaging with policymakers and letting them know that, we're a very important long-term stakeholder in the global economy, and we require policymakers to be bold in other jurisdictions. And, we worry a little bit about some of the regional disparity that is unfolding with, the kind of strong action in Europe.
Andrew, have you felt that policymakers have engaged more because of COVID-19, or are they a little bit distracted because of the emergency going on?
Look, I mean, I think it's inevitable that in the last few months, there's been obviously a fight for survival at the national level within the European Union. And the priority has been to save every job, every business that possibly can be saved during the shutdown. I certainly sense in the last few weeks the shift back towards recovery thinking, a kind of transition from crisis thinking to recovery thinking. And at the center of that recovery thinking is, look, if we don't want to go back to a trajectory towards 3 degrees global warming, if we want to go to a more sustainable trajectory, what decisions do we need to make now? And the biggest decision that Europe needs to make right now is on the budget in the coming weeks, and on the European Commission's recovery plan proposal. And look, there'll be a lot of haggling around that over the next few weeks on the details. But if the broad principles are accepted, it will be a huge boost to the European Green Deal and the financing of the green transition. All I can say is, from the perspective of the European Investment Bank as the EU bank, we are certainly taking the opportunity of the crisis to accelerate our own climate bank roadmap and transition. We're taking the taxonomy and making that the center of our strategy for the next 5 to 10 years, on both the asset side, in terms of what we finance, but also in terms of the liability side, in terms of how we raise money and link that to what we're financing. And what we are finding during the crisis, very interestingly, is that our green finance, the money we raise on the markets through green bond issuance, is becoming significantly cheaper than our standard finance. And this is because already we start to see investors being mobilized by the task force, by the taxonomy, into greater demand for green financial products. And I think that's an extremely interesting development. It's the first time we've seen it in the financial markets, a significant pricing difference between green financial products and standard financial products.
Andrew, can you maybe talk a little bit more about some of the concrete actions, so things that we can see that the EIB is taking to strengthen its contribution to this green recovery?
Well, I mean, we've made a commitment that obviously this year we're in the process of mapping every single part of our financing activity against the taxonomy, with a view to being able to disclose next year exactly what we're doing with the public's money as a public bank, and with a view to hitting the target that we've published, that at least 50% of our financing will be fully aligned with a positive contribution to climate action and the other environmental goals under the sustainable finance taxonomy. We've also made some decisions about, by the way, what we're not going to do anymore. So we have already decided to become the first multilateral development bank to stop financing all fossil fuel, unabated fossil fuel related projects, including gas projects in Europe, which was obviously a big decision for us last year, as this was quite a significant line of business for the bank over the last 20 years. And again, over the course of this year, we will move on from that decision and set out what other lines of business we will stop doing that do not meet the emissions benchmarks under the new EU Sustainable Finance Taxonomy, and that do no harm benchmarks. So on the positive side, already also obviously we'll significantly expand our program of renewable energy financing. We'll significantly expand our program of energy efficiency financing, and we also are beginning a new program of green tech, of clean tech innovation financing supported by the European Commission. So those are the whole different series of new lines of business that we're developing over the coming years, consistent with this strategy.
Erick, of course, the insurance sector was one of the first ones to address the liabilities because of climate change. How difficult is it, given the disclosure and transparency tools that we have right now, of pricing these risks, or how much easier has it become?
On the insurance products, it has become easier, and it has put the focus more on product pricing. And beyond product pricing is, where do we want to sell what kind of products? And therefore, as we have decisions to be made on the asset side, we also have decisions to be made on the liability side, or basically the products that we're selling. So physical risk is obviously, now the key risk on some of the buildings that we are insuring all over the world, depending on the weather patterns that we have. So yes, climate risk is becoming slowly, not as fast as on the asset side, because the focus is more on the financing and therefore on the asset side of the balance sheet. But it is now, we have, as a matter of fact, all of these changes has made that we are changing also our own internal governance around what we call responsible investment, which covers at the same time assets and liabilities, i.e. investments and insurance products that we're selling to make sure that we're coherent on both sides of the balance sheet. So I know that sometimes we hear in the press that the financial world is not moving fast enough, and it might be true. But when we look back, we've already moved so fast, so far. When we look at all the work around the TCFD, now that so many companies are making net zero 250 may be far, but we are working now on intermediary targets. We are trying to make the frameworks alike, all around the regulatory bodies. We have, when we look at how profound, we are changing the way we look at our investments and our business, I think that by the next 5 years, by 2025, in the TCFD, when we have the next really closest big, for me, intermediary target, you will see that in the end, big corporations are indeed moving forward. And the TCFD the TCFD disclosures are just so important, because beyond just being a disclosure or a report, it's also from the corporates. When a corporate every year needs to say what they are doing on climate change, financing their new capex in some kind of direction, and hopefully net zero to 50 also, it's putting a lot of pressure on those companies. And we can see that even the oil and gas business has been changing. In 1 year, they've been announcing incredible objectives. And sure, they are tested, sure, they are challenged to go faster and to shrink that phasing time to 250. But they are moving. I think the TCFD and the European Union are just doing a remarkable job. We are working on KPIs. We are making all of this more professional. We are making these more quantitative, qualitative. It's really going to be a game. Everything that's been going on is really a game changer. And I can see within the AXA group, with the TCFD, we are working on different types of KPIs, making sure that we have, a way to calculate those KPIs that everybody understands. Those are positive moves.
I have the results for the second poll. And so the question for the second poll was, how do you think the pandemic changed companies' efforts to go green? So 65% of the people listening in think that companies are powering ahead with green initiatives. 35% think that green is on the back burner until mid-2021. And actually, no one thinks that green is no longer a priority. Jane, talk to me a little bit about what we're seeing in financial markets. So what has changed in the market's perception given COVID-19? Could you say that actually it's accelerated the move to sustainability and to green by 1 or 2 years?
I do think it's given people an opportunity to really think about some of the big risks facing the market, and our role as investors in both trying to understand those risks, but also trying to address those risks, right? We published our global sustainability strategy last year, which is really our 3-year roadmap, and set out 3 key sustainability themes that we're focusing on, 3 E's. And it was, the energy transition. We're very committed to aligning with the Paris Agreement and encouraging all the companies in our portfolio to do the same thing. The second E is around environmental sustainability. And I think one of the elements of COVID that hasn't been as explored yet as it needs to be is the connection with habitat destruction, deforestation, biodiversity risk, and the proximity between humans and wildlife and the spread of disease. And I think that's obviously also very related to addressing the climate challenge. And our third E is around equality and inclusive growth. And I think we would be remiss to not mention, the global movement around racial injustice and the need to focus on equality, and the fact that, with COVID, of course, it's heightening some of the issues we're seeing around inequality. So I think that all investors are more faced with these very pressing challenges, which really require us to think about our tools as fiduciaries and as investors to manage them. And, we can invest in green companies. We need to do that. We need to report on how green our portfolios are. We need to divest from the brownest companies and also report on that. We need to integrate sustainability risks of all of the different issues into how we're doing our valuations, pricing companies, allocating capital. We're doing a lot to help our portfolio managers become more aware of a lot of these issues and access that kind of data that, you can do your CFA and your MBA and not really understand how different climate scenario works, right? So how do we kind of help to bridge that gap? And then our last tool is around being an engaged investor, both with companies and policymakers, as I mentioned, and advocating for things like TCFD and mandatory disclosure. So I really think that many more investors are engaged in this topic than I've ever seen. It's very positive, but I also think, the world's challenges are racing forward, and we need to make sure that we all stay engaged, or, we're going to face serious issues with our portfolios over the longer term.
Mary?
Thanks. I just wanted to add the point that I think we can all agree that the disclosure that's generated by TCFD is really essential to efficient operation of the marketplace. But it also drives better risk management and strategic planning within companies. And we hear this all the time from TCFD supporters who have generated a sustainability or other report utilizing the TCFD framework, that just the process within the company of generating that report, thinking about how to manage these risks, how to bring in the board, what is the role of management, should we tie executive compensation measures to success on climate initiatives, what does our strategic plan look like, what does our M&A policy and plan look like when we layer climate risk as an element of that. We hear from companies all the time, this is hugely beneficial to them in running the business, in addition to the obvious benefits we get from better disclosure and transparency in the marketplace.
Mary, that leads us beautifully to my third poll, which is, so everyone, please go to your voting posts. What do we need the most to make a real difference from the green transition? A, tax policy and economic incentives. B, penalties. 3, mandatory disclosure and policy. 4, US joining climate efforts. And 5, linking executive compensation to progress on the climate change. So for everyone listening in, please vote, and then I'll bring you the results of that. But in the meantime, Mary, from your TCFD perspective, do you think that financial market players understand the significant role that they can play in the green recovery, and are they well equipped to step up?
Yeah, I think absolutely yes as to both. Look, we all know the financial system is full of creative and smart problem solvers who are uniquely well suited to understand risk. And whether it's to design product or to develop strategies, the financial system can play an enormous role here. But apart from the moral imperative to act and the necessity to act to address these risks, there's huge opportunity here. I think Mark Carney has described it as the greatest commercial opportunity of our age. And when you think about the fact that the global energy sector is going to need $3.5 trillion a year of investment to transform it, carbon capture and biofuel technology need investments of somewhere in the vicinity of $100 billion a year. We need to build 400 million new homes that are green over the next 3 decades. There's tremendous opportunity, which I guess is a good thing. Be better not to have a climate crisis, but if we have it, and one way to tackle it is through taking advantage of these kinds of opportunities, I think that's great. I think the financial sector has an enormously important role to play here. Public sector alone cannot accomplish this.
Andrew, I think I have a question which I'll go to you on. Thank you for all your great questions. So just keep on, sending those questions. You can also address them directly to someone if you want me to ask something specifically. But Andrew, maybe you can start us off with this one, which is how can the Green New Deals avoid being raided by greenwashing?
How can it avoid being raided by greenwashing? Okay.
Yeah.
Well, I think because of the taxonomy that has been through the European Parliament and the European Council. And for those who are not familiar with this, the Sustainable Finance Taxonomy is basically a new classification system that's been that's been developed over the last 2 years with significant EIB support to provide a common language on what is sustainable investment, what is sustainable economic activity, and therefore what is sustainable finance. And the reporting of the delivery of the European Green Deal year by year will be mapped against that taxonomy. So in order for Europe to report successful implementation of the European Green Deal and certain levels of investment and financing under the European Green Deal, it's going to have to be consistently mapped and disclosed against the taxonomy that's now been approved by the European Parliament. I mean, this is a very detailed, this is literally hundreds of pages of technical detail under two headings so far: climate mitigation and adaptation, and there will be an additional 4 environmental objectives now mapped against the taxonomy over the course of the next year. But that's the whole purpose of this taxonomy, is to reassure stakeholders, the public, investors, savers, that when they try and put their money into what are described by the financial services industry as sustainable finance and sustainable investments, that it's not greenwashing. That this is actually making a difference in terms of climate action and environmental sustainability. One other comment, if I may, Francine, just to pick up on Mary's point about risk management. I mean, I think this is going to be absolutely central to mobilizing the financial markets. We really do have to find a way within banks to integrate physical climate risk and climate transition risk into our risk management frameworks. As anyone who knows banks well, this is really what drives capital allocation within the banking system. This is what drives pricing. It's the calculation of expected loss, of unexpected loss against certain types of activity. At most of these models in banks are backward looking. They look back over 30 years of data as to where losses come from. Now we need a different approach. We need a forward-looking approach in our risk management frameworks, and that's really challenging for financial institutions in terms of developing that type of template. But I tell you, it was one of the reasons why the EIB gave up financing gas. Obviously, it was because of our public mission and our positioning as the EU Climate Bank, but it was also because looking ahead in 20, 30 years, we did not want to be left with significant amounts of stranded assets on our balance sheet. And if Europe is going to hit its climate and energy targets, there's going to be no place for unabated fossil fuels by the 2040s. But these risk models are going to be absolutely essential in the financial services industry.
Jane, do you want to comment on how we avoid greenwashing?
Well, I mean, I agree. You know, the taxonomy is really helpful in that, right? But I think, again, we need to think about other jurisdictions and making sure we have access to the right information for companies in other markets where there isn't mandatory disclosure. So I think one of the important questions is around, you know, how do we globalize the taxonomy? How do we push for alignment and push for mandatory disclosure in other markets? I think things like, you know, Climate Action 100 Plus as well, in terms of coordinated shareholder engagement, are very helpful. I think we've also seen a big growth in the kind of NGO community and civil society who are pushing for more connection between finance and climate. And I think that ecosystem has really kind of evolved quite a bit. And I think it's very interesting to kind of see behind the scenes how the different people play a role in moving things forward together. So I think some markets are ahead of others. And I think when you look at some of the emerging markets where you have bigger challenges from an energy mix perspective and kind of bigger forks in the road in terms of, you know, what kind of infrastructure is going to be built over the coming years is where some of the bigger questions come into play. And I think, you know, a lot of people have been talking about that, but I think it's not as clear that there's as much consensus or kind of push from the right people in different markets in terms of moving that forward. So that's, I think, a pretty big concern from our perspective.
Erick, I have another question. So I have had quite a lot of questions on greenwashing, but this one is also on the controversial adaptation. So this person writes in and asks, basically, should we get used to a world where climate will be harsher and adapt to climate change rather than fight it?
I think that before trying to live with it, let's try to fight it. that's basically the decision that we all are making, by having such a huge effort, to reduce our carbon emission and to move, and to move to a cleaner way of, to a cleaner economy, globally speaking. So no, I don't think that we should try to live with it. We should try to fight it. As Mary mentioned it, there's just, there is a change of, we can still keep our economy, moving forward like it is moving today, changing to something that is more sustainable. We can do that, but we need to give time to the companies to adapt to the new economy. Just like for asset owner, we have portfolios of fixed income. So I'll speak a little bit, coming from the insurance side. On the asset side, we have a portfolio of bonds, and we have to wait for the maturity of those bonds before we reinvest. We're not selling bonds. We just have the capacity to modify our bond portfolio as we have maturities, and therefore move our asset allocation as we have bonds maturing. We need to be able to pick the right companies at that time. How do we pick the right companies? We pick the right companies because there are disclosures, because those companies are making commitments, things that we've already been saying. This is what we need to make sure that we do. Climate 100 is very important. All these alliances that are supported by the European unions, that are strong, that go one way, this is what we need to make sure that over the next 10 to 20 years, we are indeed on the way to net zero to 50. So no, we don't live with it, we adapt.
Mary?
So it's a tragic question, and certainly a legitimate one to ask. My view is we can't give up. A 2-degree world is not a world we really want to have to adapt to, and certainly worse than 2 degrees would be virtually unbearable. I do understand why global leaders have to think about adaptation alongside mitigation or prevention of climate change, because their ultimate responsibility is to keep their people safe. But I don't think that we as industry or the financial sector should be thinking in those terms right now. We should be putting all of our efforts into prevention and minimizing to the greatest extent possible the rise in global temperature.
Andrew, and then Jane.
Oh, I can only agree. I think with Mary and Eric, indeed, climate mitigation needs to be the priority. But I have to say, we do finance climate adaptation projects, and we do count them towards our climate objectives. And that's because even in a 1.5 degree temperature increase scenario, which is obviously the objective of the Paris Climate Agreement, there are going to be significant adaptation requirements, indeed in Europe, but particularly outside of Europe. And we think it's reasonable that our financing towards those types of projects is counted as part of our climate action commitment.
I mean, of course, we're very focused on mitigation, but we're also looking at adaptation. And I mean, the reality is that some degree of warming is already baked into the system. And, as an investor, I think we need to also focus more resource on trying to figure out how that's going to manifest. One of the things that we support is, as an asset manager, is GRASFI, the Global Research Alliance for Sustainable Finance and Investment, which is a network of 18 different universities who are committed to, focusing different research elements and curriculum on sustainable finance. And the winning paper last year at their academic conference looked at the fact that extreme heat isn't in the price in certain companies where it should be. And they look at different situations where you've got a supply chain that's impacted by temperature change through reduced productivity, coming through to the next quarter or the quarter after in terms of the financials. And so if you can access that information earlier, you can have some interesting information for your portfolio managers. So we're also looking at, which jurisdictions, which sectors are going to be most impacted where, because those companies need to adapt and we as investors need to track that.
Mary, I think this question may be for you. So COVID has shown the interconnectivity and interdependence between climate and other ESG risks. How can we broaden TCFD to be a more holistic framework for considering sustainability in the round?
Oh my, well, that's a wonderful compliment, but also would be a lot of work for our little tiny TCFD team. But so our remit from the Financial Stability Board is exclusively focused on climate change. But I do think it's the kind of framework that can actually translate into being effective for lots of different kinds of risks, because it takes an enterprise-wide approach. It's really, what is the governance around climate risk within your company, and that could be climate risk, it could be biodiversity loss, it could be other social risks. Pandemic, for example, companies are going to have to be thinking about pandemic risk, which I guarantee you 5 years ago they weren't thinking about. So there are, I think, risk management strategy, targets and metrics, all of those pillars of the TCFD disclosure framework actually translate quite well into thinking about other very big risks that industries, sectors, and companies might be facing in the future. The detail, of course, is how to build out the metrics and the targets and the detailed information that would be necessary to address other ESG types of risks. And that may well happen. But for now, TCFD for sure is focused on climate and getting broad adoption of the framework.
I actually have go ahead, Eric. And then I have the results from the third poll.
Okay, if I may just pick up on that, I think this is an evolution that is really important to underline. Basically, a few years ago, no one talked about ESG, and now everyone claims, if I may say, to have an ESG approach in their security selection or in their business when they make loans, for example, for banks. And in the end, the only thing that made everything move forward is really if I may say again, the TCFD. And TCFD, even before making it, hopefully, which I think it ought to be, an obligation to have. Anyway, we can see that non-financial disclosures are going to be only increasing over time, and that's for the better. To provide information so that asset managers or insurance companies, when we invest, we have access to more information on the E, on the S, and on the G. Today, we look at various types of data, given that we get from providers, and the focus has been on the E. On the E, why? Because we have made it that it has been a priority, the E, and through temperature type of KPIs with the emission amount. On the S, we are missing an equivalent of work like we've been doing on the E. So Mary, I know you have a small team. It is a call, not necessarily to the TCFD, but to something that can parallel all the work that has been done on the E side. And when that happens, I am sure that we'll come up with something intelligent on the S side with some KPIs or some forward-looking views, and that will be then we'll be able to make a link to COVID or to the recovery post-COVID in a more intelligent way than today. We just, it's just the beginning of the work. But maybe in 5 years, we could be like we are today on the E side. I think this is a maturing process and things will come along. And I think, that's why it's so important that we have things that are organized with the support of sponsors, very strong sponsors, that have transversal impact so that we can move and we can see that now we are moving. Can you believe that? We have corporates saying that they'll be net zero to 50. You would look back a few years ago, it would have been totally insane. I think that on the S, we could be in the next few years saying that it's normal and we're not doing it today.
Jane, before I come to you, let me just bring everyone the result of that third poll. So the question we had asked was, what do we need the most to make a real difference for the green transition? 38% of people think it's mandatory disclosure. 38% also think that it's tax policy and economic incentives. 4% think it's penalties, and 13% think it's linking executive compensation to progress on climate change. Jane.
Great. But that's great to see. It's really interesting, right? That there's this kind of like the carrot and the stick, provide the incentives and then make them report. Just 2 comments on, the question around should TCFD be wider and kind of where are we in terms of these frameworks for disclosure? On the climate side, I think sometimes I hear, a bit of confusion or frustration by certain market participants that, you've got TCFD, you've also got SASB, you've got CDP, you've got the Climate Disclosure Standards Board, you've got GRI, you've got a lot of different kind of frameworks. They are actually all pretty coordinated around supporting TCFD and have, kind of an understanding amongst them that they will kind of align their questions around climate, which I think is great. And there's been a lot of work behind the scenes among those organizations to really kind of drive that coordination. I think on the S side, it is harder. There are so many different S issues. I think if we look at the focus right now on racial injustice, something we've been looking a lot at around, data access and availability to data is much different in North America than it is in Europe, where in fact in Europe, in many markets, it's not allowed to collect that kind of data. So I do think that more is needed and that we could push more around collaborating. But I also think that between SASB and GRI, Share Action has the Workforce Disclosure Initiative. There are quite a few initiatives already out there that have kind of done work. And I think, maybe we need a group of people to come together and also kind of pull together some of those frameworks and say, where can we focus and which bodies are the right ones to kind of lean in and push for implementation. I think we're definitely not starting from scratch.
Mary?
I just want to make a comment on the poll, if that's okay. I don't want to jump ahead, but in terms of what will make a real difference for the green transition, I think this is sort of going back to basics. But when citizens demand of their political leaders that they confront this issue and face it in a serious way, that will make a big difference. And that's certainly an issue in the U.S. for sure. I also think when central bankers care about a subject, everybody has to care about it. And the Central Bankers Network for Greening the Financial System, I think, is the opportunity here to make an enormous difference because what they say in terms of how they regulate the banks they supervise will flow through to industry. And if they're concerned about climate risk as a systemic stability matter, then everybody has to care about that. And then I think investors, some of whom are sitting here with us today, of course, they have real power and real leverage to force business and society to confront these issues in a really meaningful way.
I'm getting quite a lot of questions. Andrew, go ahead, and then I have a couple of questions that we want to get to. But first, a comment from Andrew.
I think that's really important. The politics and political commitment and support is key, obviously, for the green transition. But for the politicians, I think what's been important in Europe is to be able to link the green transition with an economic strategy for Europe. It has been not just to present the Green New Deal as an environmental strategy, but as a jobs, growth, and living standard strategy. Maybe that's easier in Europe than in other places. Obviously for Europe, ending Europe's huge reliance on fossil fuel imports is probably going to be good for living standards. It's going to be good for Europe's terms of trade. Resource efficiency is going to be very good for Europe. But I think this is what's has been key to getting a political consensus in Europe around the European Green Deal is that link with prosperity, between prosperity and a good environment and the energy transition. And I think that's going to be key in other jurisdictions as well.
Andrew, I have another question, actually, which is just from someone who is listening in. How will the taxonomy, or you can also answer, how should taxonomy be applied to SMEs? Oh,
that's a really good question. And in fact, it is going to have to happen because, in fact, banks that finance SMEs are going to have to disclose how much of their financing is consistent with the sustainable finance taxonomy. So this is a source of great debate now within the commercial banking system about how intrusive they're going to have to be in terms of asking SMEs for the first time exactly what they are doing with the money they're being lent, not just for term finance and investment finance, but also for working capital loans. And it's going to be very important for the EIB because obviously we finance a lot of SMEs via commercial banks, intermediated through commercial banks, and we need to know from the commercial banks when they pass this financing on low rates and long tenors onto SMEs. Are SMEs using it for purposes that are consistent with the taxonomy? So we're having a very, very intensive debate and discussion with our banking partners right now about how they're going to prepare for this disclosure obligation. Look, I think it is going to have to be. It is going to have to be, managed in a way that makes sense from an SME perspective in terms of the information requirements that you can realistically expect from SMEs. So it is going to have to be modulated towards the ability of SMEs to report against this.
Mary, Europe is leading the efforts on climate change and sustainable finance at a global level. Do you think it will be the same in other parts of the world? I'm thinking of China, post-pandemic.
I do. I think, look, Europe has done an amazing job and has kept this issue alive and at the forefront of its budget and agenda for a number of years now. And I think the rest of the world should be quite grateful for that leadership. But we're starting to see leadership in other places as well, Latin America and Asia in particular. And I think even in the U.S., where we have an absence of federal leadership on these issues, we do see state and local governments, business and philanthropy all stepping up to try to fill in that gap. So I think these issues are both moral issues, but also very much financial risk issues, the rest of the world can't afford to ignore them either. And so I think we're starting to see much more leadership around the globe.
Erick, do you agree with that? Do you think this will, transition into other parts of the world?
Oh, for sure. For sure. Let's not forget one thing when we speak about Europe or the US, that, for example, when you make a commitment that, I always come back to make a commitment net zero, we are investors in companies all over the world. Obviously, a part of our portfolio is is invested more in European names, if we want to call it that way, but it's also invested in the US and in Asia. So we need to make sure that the entire world, is indeed making an effort. So we need to have leadership in all part of the world, and obviously more so, in the US and in Asia after Europe, because there it is, because they are, their emission is quite high, and they are large companies and part of our portfolios. So we need to put pressure also on those two parts of the world.
Jane?
Yeah, I think that's absolutely right. I mean, I know this discussion is mainly about Europe, but this is definitely something we all need to focus on from a global perspective. And I think the perspective of individuals is a really interesting one as voters, but also as investors, right? I mean, most of us are working on behalf of investing, retirement savings for millions of people around the world. And I think part of the really interesting elements of the European platform is around pushing for more investor preference information and providing information back to investors around how green portfolios are. And in fact, one of the kind of controversial recommendations that we debated at the TCFD a couple of years ago was whether we should be recommending, in fact, that asset owners report on the carbon footprints of their portfolios to their beneficiaries, which was a little bit maybe outside the technical jurisdiction of what we were looking at. But we really felt that it was important to kind of push that disclosure through the entire supply chain and the investment chain down to the individuals whose money it is, right? So that they have that information. And I think one of the interesting things we're discussing now at TCFD, and I mean with many organizations, is what kind of metrics are more intuitive for individuals, because a carbon footprint is not necessarily something that your everyday investor really knows how to interpret. And so an implied temperature rise is something that many organizations are focused on and looking at. And, there was a discussion earlier about how challenging some of these metrics are. I mean, they are challenging, right? Which carbon budget should you use? Which, climate scenario should you link with? Who's reporting? Whose estimates should you take? So these are all very valid questions. And we've done some analysis in BNP and found, using different third-party providers, you get very different temperatures for the same portfolio. So definitely there's not a lot of alignment currently among some of the different methodologies, but certainly there's a lot of innovation underway. And I think it's really important that we keep in mind, how to communicate on these topics with individual investors. And also that we reinforce that, climate change is a social issue at heart. Right? It's people who are impacted, and it's really the world's poorest in developed and developing economies who are impacted. So I think, those are both really important things for us to continue to focus on.
Andrew.
Just one comment to complement what Mary has just said. I think in many developing countries, obviously, multilateral development banks play a particularly important role. And I do think it's important that the public maintain the pressure on multilateral development banks to evolve their eligibilities and their own reporting to drive this agenda, even in developing countries, consistent with the type of taxonomies that are being developed through the international platform. I have to say there are still very different approaches among multilateral development banks as to what is consistent with the Paris Climate Agreement. And it was, after all, huge stakeholder pressure and public pressure that forced the European Investment Bank to move in the last year on these type of issues. So I encourage the public to keep up the pressure on the multilateral financiers as well as the private sector.
Andrew, I have another question, which may be one for you. What is the incentive, aside from the moral one, for a small country that has minimal carbon footprint as a world percentage to keep doing green initiatives whilst US and China pollute massively?
Sounds like Ireland, maybe. Well, look, there is a big moral imperative. There's a free rider issue here. No country should be allowed to free ride, obviously, on the efforts of others, no matter how small they are. So I think this is an important principle of kind of international public policy, that everybody make a contribution. But I would not position the green transition as a big cost, as a big kind of cost in terms of living standards and economic development. I mean, I think what we're seeing, obviously, particularly in renewables in the last decade, is the collapse in the cost of the price of renewables to a point where it's now, in many cases, starting to outcompete traditional sources of energy, of fossil fuel energy. So look, this is an opportunity, in fact, to create jobs, to improve our living standards, to lower energy costs, and to develop a cleaner environment. I don't think it's right to position this as a kind of sacrifice that a country has to make for the sake of the global environment. It's an opportunity.
Can I ask maybe Mary to kick us off with, how can public and private sector join forces to accelerate climate-friendly investment? And, are public-private partnerships more important than ever?
Yeah, they are absolutely essential because the public sector simply cannot do this on its own. Last year, a group of 7 major investment banks under, again, Mike Bloomberg's leadership formed something called the Climate Finance Leadership Initiative at the request of the UN Secretary General. And they produced a report that tried to identify the challenges and the solutions to scaling private finance to deal with the climate crisis. And one of the things they highlight in there is they lay out each challenge and a solution for public policy, private finance, and public finance, is that the development finance institutions have a huge role to play here, partnering with banks and asset managers to share the risk, to co-finance projects, to develop new instruments, to expand the pipeline of investable projects. So there's a big opportunity for public and private finance to work together. But it's not just an opportunity, it really is an imperative if we're going to tackle a challenge of this size.
Jane?
Yeah, I mean, absolutely. I think that everybody needs to be involved, and I think it's in everyone's interest to put those policy incentives into place. And as we saw from the polls, we need the carrot and the stick. I think, just coming back to the question around, the trade-offs and the free rider issue, I really think that there's a missed opportunity to provide a kind of more focus and more of a spotlight on all of the economic opportunities associated with the transition. There's initiatives like the New Climate Economy and others which have shown, that there are huge opportunities here, transitioning away from polluting, a kind of more of a polluting economic model, which has also a lot of health implications, which of course have a major drag on the economy, towards something that's, competitive today in most markets in terms of new installation. So I do think that we all need to maybe try to shift that narrative to really look at the opportunity, because there's definitely kind of a broad sense that there's this big cost associated with transitioning that I think we need to try to crack.
Erick, what do you think the role of private-public partnerships will be when implementing the EU Green Deal or any green initiative?
Oh, I agree with the comments. One cannot work without the other. But I don't think that it has to be a system where basically the private sector is put on the defensive. So I think they need to work together. We know that in some sector or geographies, we need the support of the public sector, because they know the local leaders, and they do provide a backup or help, when we invest in areas that are not so stable over a very long period of time. And I'm speaking more, if we were to invest in Africa or in South America, it is really important to have, to invest hand in hand with the public sector. I think we don't take that. We are undermining the importance of the public sector in some geographies. We think that basically we invest in Europe is the way we invest in the entire world, and it's not true. Europe is very specific, and so when we go to South America, I look at our investment portfolios. We are mainly a developed market oriented investment portfolios. Europe and the US and a bit in Asia. We need local leadership to help out. If we want to support and participate in financing, we need to do it hand in hand with all the public banks. It is a no regret move, and only if the public sector is alongside the private sector will the private sector go into those geographies.
Andrew?
So I think obviously there is the real job of the public sector is to set the framework conditions for in which the private sector operate, the carrots and sticks as we've been describing them today. Obviously, one of the carrots is the disclosure environment, is against the common taxonomy. I think that's going to be really important. I do think the sticks are also important. I think pricing is really important, and carbon pricing. And I think what the Commission have done in terms of reforming the emissions trading system in Europe the last few years has been extremely helpful for the renewables industry. And I think there's further work to do outside of the sectors covered by the emissions trading system to get better price signals to drive the market. I also think there is a role for public finance. It's only a complementary role to the private sector. But the public finance and public financing institutions can help get markets moving. They can help move markets into new areas. So, for example, the offshore wind industry in Europe, would not have grown without public finance and without public financing institutions like the EIB. Now, it's only to get an industry to a certain point, and then the private sector needs to take over, and the public finance industry needs to move into the next sector and really be focused on market failure and additionality. But there is a role, and so we're moving on now in some respects from maturing technologies, and we're looking at the next wave of technologies that still is too immature for private sector finance.
We're almost out of time, so I just want to ask each of you what your, maybe 2 or 3 priorities for the next 12 months will be and should be. Mary, apart from maybe, getting a bigger team, given what we were discussing earlier, what will you be focusing on?
So we'll be focusing, as we prepare a status report for the G20 for this fall, on TCFD developments and implementation. We'll be focused on refining some of the guidance that exists for different sectors. We'll be working a lot on scenario analysis on a sector-specific basis, and we're looking at targets and metrics and how we can, again, on an industry-specific basis, provide better targets and metrics that give more decision-useful information to investors. And then we'll focus more continuously on implementation of the recommendations. Tremendous number of supporters, as I said, but they need to begin this journey of disclosure. It needs to become increasingly quantitative and sophisticated. And so we'll be pushing companies to do a better and better job with disclosure.
Jane, what will your 2 to 3 priorities be?
Sure. So, as I mentioned, we've got kind of 4 areas: invest, divest, integrate, engage. On investment, we're looking at a new long-short strategy and also a new fund around sustainable infrastructure. On the integration side, doing a lot of work around both climate transition risk as well as physical risk and reporting. I think that's a big area. And then on the engagement side, on the corporate side, we're very focused on tackling climate-related lobbying, have filed some resolutions this year on that topic. I think that's critical to kind of reduce the lobbying against climate mitigation. And at the same time, we're focusing on working with policymakers to encourage them to be bolder in terms of climate-related policies in other jurisdictions.
Erick?
Well, 2, 3 priorities. Number 1, obviously, on the climate, that we all agree on the matrix. The matrix, so that we can work with our asset managers in order to start making decisions that are putting us in line with 2050 and even before, when we'll have intermediary targets. That's for our portfolio of assets for the company. Then there is a new regulation next year coming out on financial disclosures for all insurance products that we will have to make available to our clients. This is something new, coming back to a bit of the discussion as to what we should be providing in terms of sustainability to our clients. And number 3, something that we have started to work internally on, and that is the role of carbon capture and storage type of technology. Should that be included in our own pathway within the companies? What role should those CCS play in the achievement of our various type of targets?
Thank you, Erick. Andrew?
Just very briefly, complete integration of the new sustainable finance taxonomy into our business strategy on both the asset side and the liability side. Obviously, we need to also develop a new set of instruments, debt and equity products, obviously to support that business strategy and to support the recovery plan that the European Commission has proposed to the member states. And then finally, some of our shareholders, the member states of the European Union and indeed the European Council President, have suggested the EIB should do even more than we proposed, but that will require a capital increase for the institution. So we just need to see if we now need to negotiate with our shareholders a capital increase for the bank and all the associated governance reforms and business strategies that need to go along with that.
Well, thank you so much for a very engaging and charismatic conversation, Mary Schapiro, Jane Ambachtsheer, Erick Decker, and Andrew McDowell. And thank you so much for everyone attending.
Thank you.
Thank you.
Thank you.